Welcome, everybody, to the Thursday edition of the Not Your Average Investor Show. Today, we've got a very special topic. We've been talking a lot about market conditions and the economy and whatnot, but it is time to hit on what are the metrics that you can always look for. How do you pick the right market? How do you analyze markets for rental property investing, for real estate investing, despite whatever economics are out there, right? There's things that are always going to be true. I'm your host, Pablo Gonzalez. With me, as always, here in studio, the man that I affectionately like to call GC because of his genius concepts. Today, he's got some genius concepts because he knows how to generate cash flow, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be with you today.
And with us in studio today is the mama bear of the community, Cody Adams, our community manager, who is in the chat helping you out. Anything that you may or may not need, she is the person that you reach out to. Cody, you want to say hi to everybody?
Hi, everyone. I'm so excited to see everyone today. I'm in studio. We've got good news today, too.
Oh, yeah, we got some good news today. That being said, what we like to remind everybody is that we've got the Not Your Average. We have a new name for it, actually, the Not Your Average Investor Summit coming up. We want you to save the date where we have our community gathering around here in Jacksonville, Florida, February 16, 17. GC, what are you most excited about?
Man, I am so excited to meet all of you. I am so excited just to get to shake your hand, to say hello, to have you come and see some of the magic that we have here at JWB, in our community. So I think it's the people. It's the energy. It's the magic of the room is what I'm most excited about.
Yeah, I agree. Listen, I think everybody that's part of our community, everybody that tunes into the show, they're into rental properties, right? Like you wouldn't be listening if you didn't either have one, thinking about getting them, or thinking about getting some more,
Sure.
Or very curious about it. But while anybody can show you an investment, while anybody can show you a sheet that says this thing's going to maybe perform, and maybe even you might even go see the asset, right?
Mm-hmm.
What I think nobody can show people, right? Or very few, and it's hard to deny when you see it, is the value of vertical integration and a team, right? Like in this scary investment that's going to last a long time, knowing who's taking care of you for the long run, that to me is invaluable. The value of seeing a city that's about to pop, right? Like this idea of walking around the downtown that you're like, man, I can just feel it, right? Like there's no way that we can tell you about this in a way that you'll actually feel it unless you show up. And third and foremost, the value of a community, right? Like I think this feeling of belonging that everybody feels when they come to our past meetups, which is now a summit because it's a big deal.
We made it.
Yeah, we made it. We made it. I'm really, really excited for that. February 16th and 17th. Save the date. Make sure you be there because you're going to get to meet some of the people that we shout out right now. And what, GC?
The roll call, baby.
We got our leadoff batter leading us off today.
John Henning.
John Henning, you know this. We got the maven from the mountains of Denver.
Ms. Leslie Wilson.
Leslie Wilson. We got the MVP. You may have heard of him.
Mr. Lee Bishop.
Mr. Lee Bishop. We got Leo Faragana.
Dun, 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 dun,
Faragana.
dun, 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 dun.
I like the back and forth there. We didn't just do the whole thing. Yeah.
You know, it's like we've done this once or twice.
Welcome back, bro. A sunny Bay area. We got the ringmaster in the house.
Drew Barnell.
We got the early bird in the house.
Mr. Dean Curry.
Who else? We got Laura Colby checking in from Washington State.
Welcome back. Love that.
Yeah.
Representing Washington.
Pamela Myers in Seattle. We go. We may have to get out to Washington.
JWB clientele coming full on.
Go to the Pacific Northwest and the mountain of Miami.
Billy Green.
Billy Green from the frosted treed mountains of Colorado. We got Pedro Nascenseno from
Jersey.
We got Marilyn Cotterman from Homosassa, Florida.
That's the home of the manatees, Pablo.
The manatees.
We haven't talked about the manatees in a while. It's so nice to see you,
manatees when you're not around. We love having you here, Marilyn. We got Margaret Smith back in the house. Wait, Margaret got a nickname, didn't she? Last year.
So many great questions.
Yeah, what was her?
Margaret, help us out. We won't forget next time.
Promise. Who else we got in here? We got the patriarch and matriarch of the first family, Ken and Carolyn Meline.
We salute you.
Good to have you in here, Melines. Anybody else? We got Sergio Preto.
Go Gators.
Go Gators. Sergio, good to have you out here. Scrolling through. We got Tom Inman from Jacksonville Beach.
All right, Tom. Welcome. I think so. Yeah. Tom. Welcome to the party.
Welcome to the show, buddy. We got Vincent Barbarites from Long Island.
All right, Vincent representing all the coasts here.
Yeah.
You know, I know Vincent's name. Let us know, Vincent, if this is your first time. I think you're a client. So thank you so much for being here.
I can't believe this. Albert Gamelon from Minneapolis, California.
What?
Albert, we had somebody from Milpitas, which we pronounce Milipitas around here, and he left. So now you're from Milipitas.
Yes.
Happy to have you here, Albert. We got JC in the house with a good morning.
All right,
We
JC.
got Sylvie Lumumba from Worcester, Massachusetts.
New name?
New name.
Oh, right.
A lot of new
Love all the
names.
new names here. Thank you guys for coming here.
This is awesome. Call me questions everything, Margaret. All right, questions everything, Margaret. Yeah, Albert from Milipitas was Louis Hudno, but he moved to Rockland,
That's
California.
true. That's true.
Yeah, we got Matthew Edwards from VAB, Virginia Beach.
All right, Matthew.
Good to have you.
Sounds
Happy
good.
to have you here. All right. Here we go. Well, Vincent says, always listen, first time in chat. Yes, a client, 3 properties, and we'll be adding more shortly. Let's
All
go,
right,
bro.
Vincent.
Let's go, Vincent. All right.
All
Cool.
right, my friend.
Man, that's a good roll call.
We're fired up.
I'm a big fan of it. Pamela Myers has a question regarding JWB Summit, the Not Your Average Investor Summit by JWB, Pamela. When will we get all the details? Will there be a block of rooms, specific hotel to book, or should I book somewhere in downtown? Will rental car be needed? Funny you ask, Pamela, because
Interesting.
we got breaking news. Did you see what's the breaking news?
We do. Pamela, you ask and you shall receive. We are officially opening up the registration for the Not Your Average Investor Summit. February 16th and 17th, like we mentioned. And guess what? You all get to officially book your tickets to come and be a part of this special party. Pablo, what are you most fired up about?
Oh man, Margaret says, I'm a karaoke virgin. Help me with that in February. I'm pumped for the karaoke. We're definitely doing karaoke when we are together. And I'm pumped that we've taken this thing from like a meetup to a buyer's tour to a summit. This is a big deal. We're going 2 days. It's going to be bigger and better than ever. I think that this is really the platform for what's going to end up being a very special event that's going to continue to grow, continue to happen, and really become something. And I'm somebody that goes to a lot of events, right? Like I'm a fanatical networker. And what I find is that, and I'm not, I mean this, right? Like, generally year 3 is the best time.
Yeah.
Right. Cause like the first year you go, it's cool. It's intimate. People kind of like are figuring it out. Year 2, people start to catch on and it happens. By year 3, there's this like magical alchemy of the people putting it on know what they're doing finally, which I feel is very real for us.
True.
And there is this like ongoing storyline of people that have been here a couple of times, that there's like this like real alumni base. And that's when it really starts to like happen. I know that different conferences that I've gone to, when I go year 3, it's always my favorite. And I'm really pumped for us to hit that year 3.
Me too. Me too. And you know, this is something that is so special. We're opening it up. It's going to be a small event because if you came last year, probably one of the things you loved was the magic of the room. It was the community. It was that sense that you got when you walked through the door. You got to shake the hands of those folks who you might see in the audience here. You might get to, you know, you haven't met JWB yet. So that magic is going to be preserved in the event. So go ahead and get your tickets, guys. It's $99 for you to come and be a part of the event. And we've got the website all set up.
Yeah, we haven't said the website yet.
Well, let's go ahead and do that. So it's jwbrealestatecapital.com/summit. jwbrealestatecapital.com/summit. $99 a ticket. We have more and more details we'll be sharing on the show as we finalize all those details. So we'll have all that stuff laid out for you guys. And then the tickets will stay $99 until January 14th, at which point they'll go up in price. So go ahead, sign up and book your ticket. We can't wait to hang out with you guys.
Yeah. And to Pamela's question, she asked, will there be a hotel block? Will there be all that stuff? All that stuff is coming. Cody is fast and furious working on updating the website with hotels and different things and all this other stuff. And it's taken extra because first we wanted to make sure that we're going to deliver on everything that we were promising. And second, we got some surprises coming.
Oh, we do.
We got some surprises coming in the way of like speakers, people that we're gonna allow you, we're gonna facilitate you meeting and getting to know and learning from. We got some surprises coming in swag, which I know, I'm not gonna say too much.
Yeah.
And a couple of other little delights for the insiders. For those of you that show up here every week, there's going to be a couple of extra things.
I mean, we can't say who yet is going to be speaking. We know we're going to be sharing that soon, but we're talking about billion-dollar decision makers in the room speaking to us. We're going to be talking about highly influential leaders in the city of Jacksonville. We're going to be talking about JWB and our developer friends. So it is something, I don't know if there's ever been a summit or an event like this in Jacksonville. So can't wait for you guys to be there. Super pumped.
I'm super pumped. So jwbrealestatecapital.com/summit Cannot wait to see you there. Let us know in the chat if as you start buying them. I saw on Tuesday, everybody's like, I'm coming. I think we had like 14 people. So let us know if you sign up and you actually do it. I'll call out your name and on with the show, man.
Let's do it, baby.
I don't know if I can do a show now, GC. I'm too excited about
I'm
this.
very, very fired up about every moment. It started with your whatever you did to start the show. The roll call was awesome, talking about the summit. Now we get into, why I was up burning the midnight oil last night.
That's right. Just so you all know, I got a text from GC at 2 a.m. saying, hey, buddy, not going to be able to go running in the morning because I got really deep into this data that I started gathering. So what I challenged Gregg to come up with is, hey, Gregg, we've done this like investment scorecard. We have our criteria. We know that we want to pick a market that has lower than average prices, right? Like national prices, because it has upside, higher than average rents, because that means that there's like a higher demand for rent. That is risk of what is it?
Talking about risk adjusted returns. That's how we deliver risk adjusted returns.
I'm just saying that lowers your risk, right? Because if
risk mitigation is what you're going.
Risk mitigation is what I'm going for. We know that we want higher than average home price appreciation because at the end of the day, when you're holding for a long time, the bulk of the returns come from that. But I wanted to challenge GC, how can we go deeper in that data? How can we really look at all 5 profit centers, including those, and put something in front of folks so that they can start to really understand how to do this stuff? GC, you want to tell me kind of a little bit about your journey here?
Yeah, this is data that this is the first time I've been able to put it together and share what I think is like deep in my soul about why I love this asset class so much and why I love Jacksonville so much. It's when you're sitting in my seat and all the other different markets and which markets are good for certain things and other things, right? And I have the access to all that information. I know why I love Jacksonville so much, but it's been hard to compile all the data objectively to paint the picture because real estate can be complicated. You got different property insurance costs in different markets. You got different property taxes in different markets. Obviously, you need to have some information on rents and all this good stuff. Well, here's the deal. All of that complicated process we were able to do. We were able to get it together, all that data together through the help of our consultants. And I was able to put this together. And as I was going through this late last night and putting the finishing touches on it, my vision was I wanted to share what's deep in my soul, why I love this so much, and make it easy for you all to see it as well. And so it was really cool as I'm going through and putting the data here. I'm like, okay, cool. This is telling the story that I have known for so long. This is clear. This is easy to understand. And so I'm super pumped. I think it's going to help people see what we see here at JWB and what many of our clients see as the reason to invest in this asset class and why to choose one market maybe over another.
Love that. You want to take a guess at who the first person to buy a ticket is?
Jen?
Dean Curry, bro.
Oh, gosh, I missed that one. Of course.
What a layup.
I screwed that one up.
Dean living up to his name, the early bird.
Good job, dude. That's awesome, man. Can't wait to see you guys.
Yeah. All right. So GC, so you are pumped about what you find. Ringmaster just got his.
All right.
Drew got it. Where did you go to find this stuff, man?
Well, so it's kind of a 2-part answer here. The best way to get objective data here is to pay a consultant to get it. And so we have a great relationship with our consulting firm. It's John Burns Real Estate Consulting. John's been a guest of the show. It's kind of the industry standard for our space across the country of providing this high level data. It's tested, it's validated, all that good stuff. Costs money though. So that's what I've used to put this information together. That's really the only way that it was good enough data for me to share it here on the show and know that you all can have confidence in it.
Yeah. John Burns, past star of the show. He has like 100,000 followers on Twitter. Big deal guy in the real estate world. You guys pay them a pretty penny to do proprietary research. Every single month we get these reports. You have access to that because you're a $1 billion company.
Well, not a $1 billion company yet, but I love you being the hype guy. We'll be there eventually, right? But yeah, so there's that information. What I also wanted to share with you is that as I'm going through this information today, there are places that you can get really good data and kind of put the information together for yourselves so you don't have to go and spend money on a consultant. So we can kind of get into some of that, right? When we're talking about rents and home prices across the country, Zillow is a pretty good source of data there. They have per market information. Zillow on an individual property basis, I wouldn't use that to make the decision on their Z estimate of what what the property's worth. But when you're comparing an entire market, it actually is pretty good information. So you can get good information on home prices, rents from Zillow and some of the major aggregators like them. You can use the US Census for rent information. It's a little bit lagging, but it's the US Census, so it's strong and validated there on the rent side. And then for home price appreciation, you'll want to go to the Federal Housing Finance Agency website, all free, of course. But they have a home price calculator tool where they actually show you, and you have to do a little bit of the math behind it, but you can actually get the long-term historical trends of what home price appreciation is per market. And these are all free resources for you to use as well. And so that's what I would go if you don't want to spend the money. Or you can just keep showing up here on the show. I use all the data that we spend money for, and I use it to, of course, prepare for our shows and share that with you all too.
So if you are passively looking for the data, you can pay John Burns big money to do it, or you can come to the show and have Greg do it for you.
There you go.
If you want to go find it yourself, you said Zillow, the census. What was the other thing that you said?
Federal Housing Finance Agency.
Federal Housing Finance Agency.
FHFA.gov.
And anything else?
Those are the three sources that I used before we started to pay John.
Cool. All right. So now let's get into this data. But before we get into this data, I got another little piece of data for you. Lee Bishop also got 2 tickets.
Yes.
Pamela Myers also got 2 tickets. We already
2
on the
tickets
way
to paradise, baby.
We are already on the way to selling this thing out, which I'm sure is going to happen very, very quickly. Renee de Hombre, 2 tickets done. Let's go,
right,
Renee.
guys. This
Pumped
is awesome.
to meet you, Renee. All right, cool. So let's get into this presentation. Here we go. It's right here, GC. So,
all right.
You're about to throw some numbers up there.
Yeah, we got the typical lawyer speak here, right? Listen, I've used a lot of this data. I'm calculating returns on investment and profits over a long period of time. Anytime you do that, you should do your own due diligence in addition to listening to what we're talking about here. These are estimates. They're not guaranteed. We're not financial advisors. We're not offering financial planning advice. And with that, let's jump into it.
Leslie Wilson's also coming. Leslie, can't wait to hang out with you again.
Couldn't be an event without Leslie.
Going into it. All right, GC. So first of all, you made an assumption of like what the asset is, right? Or not yet. I'll let you take it from here.
Well, here's my thought process. Okay. My first thought is, as a newer investor, somebody coming into this space, you might be saying, well, what part of the country should I be investing in? Is it better for me to be investing in a market out in California or New York or Atlanta, Cleveland, or Jacksonville? What makes one of these markets better than another? And so I wanted to start to go through that thought process. And what I did here is, you can see the different cities here: San Fran, New York, Atlanta, Cleveland, and Jacksonville. And I broke it out by the median sales price, median gross rents, and a few other things. You'll see that I specifically noted SFR workforce median sales price. That stands for single family residential and workforce housing, because what I'm doing is I'm normalizing the investment in JWB assets in Jacksonville to that same type of investment in many other cities across the country. So these are all single family residential workforce housing median home sales prices, which are below what the normal median is. And it's objectively standardized to do that. Same thing for median gross rents. This is specifically for single family residential workforce housing, median gross rents, as a way to standardize and normalize across the country. You see the total initial investment. That would include your down payment and your closing costs for one property. So you can start to see the difference between the higher priced markets and how much money you have to bring out of pocket to buy one asset versus the lower priced ones. And then you start to see some average annual rent price appreciation and average annual home price appreciation. And this information comes back for 30 to 40 years. The data goes back, and we start to see how much have rents and home prices appreciated in those markets over the long haul.
Got it. And so if you are listening to us on the podcast, you're going to want to go to YouTube to, see this stuff. I'm going to summarize it as much as possible without being like, punch me in the face data or stuff. But Greg chose San Francisco, as you can imagine, the highest home price. New York, second highest home price. Atlanta, which is kind of like right in the middle. Now it's much lower than those markets, kind of like comparable to Jacksonville pricing as well. Jacksonville's in there, and Cleveland that has the lowest price. And the initial investments go along with that, right? So San Francisco, you'd be looking at $483,000. New York, you're looking at $184,000. Atlanta, $110,000. Jacksonville, $105,000. Cleveland, $63,000. And what you then see is average rent appreciation and average home price appreciations that have San Francisco averaging rent appreciation of 3.7% and home price at 6.3, New York at 3.8% rent, 5.3% home price, Atlanta at 3.6% rent and 4.3% home price, Cleveland at 2.7% rent price, which is the outlier here. Everybody else here is kind of in line, and 3.3% home price, and Jacksonville at 3.7% rent and 5% home price appreciation. Anything that you want to point out there, DC?
Well, yeah. So if you're thinking, okay, how's my money going to best perform? You would think that higher rent price appreciation and higher home price appreciation is a signal there. You probably want to have your money in places where there's higher of both of those. But does that necessarily equate to a higher return on your investment? Because if you had to put out so much more money, but you got more home price appreciation, is it worth it? Does it have a return on my dollars for putting it out? So while this information really sets the stage and sets the table for the market metrics here, we need some additional steps for us to actually figure out where's the best place for me to put my money.
Okay, let's take that step. For me, it's a click.
Well, what do you know? For me, it was like 4 hours last night. It's one click for you.
By the way, speaking of clicks, Ride Along Raj is signed up. He's riding along with me again.
Fantastic. The crew is here.
Yeah.
So I think that's my job here. That's our job at JWB, is to help people go from how do I do this asset class to where do I invest, and why does that make sense? Why is that going to deliver more of a financial return and a better risk-adjusted return for you?
Got it.
So here's what we did. We took $483,000. Let's say that you had $483,000, Pablo, and you're going to buy and hold on to a portfolio of single-family rental properties in any of these markets, and you're going to do it for 20 years. We're looking at which national market delivers the best risk-adjusted return on investment. Risk-adjusted is really important. We'll talk a little bit more about that. But when you start to actually break it down, and the next thing for us to do is actually break it down into the 5 profit centers, you start to see where some of these markets really win and where some of these markets don't win. And so you can kind of decide, okay, which is the right market for me? Which might have higher total profitability, but have more ability, more risk associated with it, right? One example of that might be San Francisco. Okay, San Francisco, we know, is, if not the highest priced market in the country, it's certainly one of the highest priced markets in the country. And when you have high home prices, even though you had high rent price appreciation, you have high home prices, really hard for your assets to produce positive cash flow for you. And it starts to add up. So over 20 years, if you bought one investment property, which is that $483,000 investment in San Francisco, can you read that number for me, Pablo, of how much net rental income you're losing over that time period?
Yeah, it's a number in red and parentheses, which means you're in the negative $722,000 in net rental income.
Yeah, I'm just doing the math in my phone here. That's $36,000 a year of negative cash flow.
Yeah.
That's $3,000 a month. So when we talk about how, and all that is risk. Anytime you got to pay money out of your pocket, that's the riskiest thing you can have, right? So there's that risk that's brought to that San Francisco type of investment, which is a reason why most single family rental property investors don't even have San Francisco on the radar, right? We're not thinking about San Francisco as a play for single family rental properties because there's just too much risk, specifically because of the net rental income.
Got it. And if you go down the line, New York also has $712,000 in loss of cash flow. Atlanta has $131,000 in negative cash flow as well. And shockingly, Cleveland has $243,000.
How about that, huh?
That shocked me the most, because we always keep talking about how Cleveland doesn't have a high home price appreciation, so people go there for cash flow. Why is this, GC?
Well, so part of this is the way that I built this to be objective and standardized across. I assume that there's 35% down for these investment properties across the board. and a 6.125% interest rate, which is what we're able to get for JWB clients and what I would assume you could get in some of these other markets.
Mhm.
You know, that 35% down is a percentage there where, you know, year one cash flows in any of these markets here, year one cash flows are negative, right? So at 35% down, and it's just the way the data transpires. JWB properties are cash flow positive, but just the way to be objective, these are all negative. And so it took a lot longer for Cleveland to get cash flow positive than Jacksonville.
Or even Atlanta.
Or even Atlanta or some of these other places.
Yeah.
Do you know why that is?
Why?
Go back to the other slide. Look at, and this is what many people miss. Look at, no.
The annual rent appreciation?
You got to go. Now,
I went the wrong way.
yeah, you got to go the other way.
Sorry, buddy.
You know what? That's the next reveal there, buddy.
Okay.
Go and look at Cleveland. 2.7% annual rent price appreciation versus every other city on that list, right? The amount of rent price appreciation over 20 years is significant. And so because Cleveland rents do not increase as much as some of these other markets, they actually lose compared to the net rental income of some of these other markets over the long haul, over 20 years. So when you're thinking about this type of investment, you should be thinking about a full market cycle. You know, everybody day one is like, oh, well, what's the cash flow day one? What's the cash flow day one? Well, guess what? The big things that you should be looking at is, of course, cash flow day one is nice to know, but how much does my rent grow over time? Because if you start out cash flow negative in one market, but it doesn't grow a lot, then this is actually going to be a negative cash flow investment for you over the long haul, which is what we see in Cleveland. Now, let me give a caveat here. This isn't to say that you can't find a positive cash flow property in Cleveland or Atlanta, because you can. This is the objective standardized way to look at it for single family residential workforce housing. You could put more of a percentage down to be cash flow positive in some of these markets or another. So don't let that be the takeaway that it's impossible to find positive cash flow in these markets. But if you're using one standard approach across all of these metrics, this is really the standardized way that it shakes out.
Got it. So, you know, just to kind of summarize the bottom lines here, San Francisco, you get a total profit of 2.2 million at 7% IRR. New York, you get a total profit of 1.3 million at 5.3% IRR. Atlanta, you get a profit of 1.5 million at 6.7% IRR. Cleveland, you get a profit of 901,000 at 4.7% IRR. And Jacksonville, you get a total profit. Jacksonville, we didn't even mention, Jacksonville has positive cash flow, right? Like positive cash flow of 122K and total profits of 2.11 million at an 8.7% IRR. Is there a reason to not do Jacksonville? Like what is, like, if I'm looking at this thing and I see a higher IRR and I'm seeing that this thing is cash flow positive, you know, I think of like investing in, if I'm investing in like net cash flow negative housing, I'm assuming I either have other supplemental income that is going to like make up for that cash flow. I have a very, very high salary of expendable income. So I'm not super like risky on that. So I could see why I would go negative, but the combination of negative cash flow and lower IRR, make an argument for another market.
I'll make the argument for San Francisco. Okay. Let's say that you are all about home price appreciation. And in San Francisco, if you have the ability to weather the storm for net rental income, you're going to see $3 million of home price appreciation based on what has happened in San Francisco over the last 40 years as far as home price appreciation. But if you wanted to make an argument for the San Francisco market, you could say, hey, listen, I'm down to take the risk. For every 1% additional home price appreciation now that happens, maybe more than what's happening for the last 40 years, you're going to have a much bigger payoff in San Francisco than you would for any of these other markets. So if you really are able to take on a lot of risk, if you have a lot of net rental income, you could say, well, that would be the reason to do it. But it doesn't make a whole lot of sense once we step into the risk-adjusted return on investment conversation. I don't know anybody who's doing that, right? I don't know anybody who's making that decision because in my mind and most people's mind, the risk that you would take on to go 700 grand negative over 20 years is not worth you banking on there being a huge pop in additional home price appreciation in San Francisco that you haven't seen. At the same time, people are leaving California, the state of California. So there's that demand is certainly to be questioned.
Yeah, it wouldn't be, I guess somebody would doing it isn't making a numbers decision. They got to have a hunch on something else, right? Like maybe they're like, well, San Francisco right now is depressed and I can get a deal or something like that, right?
This is macro data
Yeah,
here,
it's
right?
Okay.
You know, this is to give a viewpoint of a 30,000 foot viewpoint of where your dollars can best serve. If you happen to know, you know, some inside information about something that's going to happen and it's in San Francisco, maybe that's the reason you do it. But from an objective 30,000 foot view, it doesn't make a whole lot of sense.
Interesting viewpoint. Margaret Smith, who I remember her nickname. She's the Jeopardy Queen.
Oh, the Jeopardy Queen.
She knows the questions.
I'm writing it down.
Jeopardy Queen Margaret Smith asks, did I miss why Jacksonville gets lower tax savings than the other markets? Is it due to state taxes, which Florida does not have?
Does it get lower?
Why does Jacksonville has less tax savings than, say, New York and San Fran?
No, there's just not a K behind New York and San Francisco. That's $377 total of tax savings in New York and $289 total of tax savings.
Wow.
Yeah, I know. I probably should have highlighted that a different way. That's like not even $1,000 over 20 years.
20 years.
And in Jacksonville, you get $44,000. So I'm so glad, Jeopardy Queen, that you asked that question. Your tax savings is a relationship between how much net rental income you have.
Yeah.
And so it takes a long time for you to get cash flow break even in San Francisco and New York. And that's why you don't get much tax savings.
And
there.
that's why she's the Jeopardy Queen. We would have all missed that.
There you go.
Anonymous Attendee says, sorry I missed this, but why'd you pick 438K as the initial investment again?
I'm so glad you asked that as well. So 483,000 is what we chose here. And the reason was to standardize the portfolio amount across the different markets. So if you go back one slide, I'll show you why I chose that number. There you go, the other side.
But I go backwards on the thing and it doesn't.
Really?
Yeah.
All right. So you can see in the San Francisco, California column under total initial investment, one property. I said, you're not going to buy a fraction of a property in San Francisco.
Yeah.
So you buy one whole property in San Francisco, it's 483 grand out of pocket. Then let's say take that same pile of money and see how many assets you can buy in the other markets.
Got it. So we had to go to the highest common denominator.
There you go.
Right.
There you go.
All right, cool. So that's a really interesting picture on a national level GC, right? As everybody has seen, since these keys aren't working correctly. You then went and compared it. You know, you did the thought experiment of like, okay, cool. I've looked at the country. Really, what I want to do is invest in the Southeast. I'm super hot on everything happening in Florida, low tax base. It's going to be growing. All this other stuff is happening. So you went straight into Florida and you compared Orlando, Tampa, Miami, and Jacksonville.
Absolutely. Many people have said to themselves, I know what's going on in Florida. I know people are moving to this state. I know population is growing, and they know that has an impact on a high floor for profitability of a real estate investment and also high upside. And so if you're one who sort of circled Florida and said, well, that's where I want to build my real estate portfolio, I then circled in and said, okay, well, what's the standardized approach between Orlando, Tampa, Miami, and Jacksonville? And you can see the same kind of thought process. So we've got single family residential, not Salesforce, single family residential, workforce, median home sales price, gross rents, the amount that it would require from an initial investment perspective in each of these markets for one individual asset, and then rent price appreciation, home price appreciation.
Got it. And to me, what's interesting here is I think it goes what I would expect. I would expect Jacksonville to have the lowest overall price. I would expect Miami to have the highest. I expect Tampa and Orlando to be somewhat comparable. And then as you look at the bottom two rows of average rent price appreciation, it looks like everybody is like between 3.7 and 4.1, Tampa being the highest there. Jacksonville being tied for lowest with Miami at 3.7, but not a very big spread. And then you look at the average home price appreciation. Orlando and Jacksonville are at 5% HPA, Tampa is at 5.4% HPA, and Miami is at 5.8% HPA.
So let me just stop here because I think Jacksonville historically has been, under the radar, right? When especially when foreign investors are thinking about placing their money, they don't even have Jacksonville on the consideration, right? But they do want to get the best return on investment. All they know is, I know Orlando, I know Tampa, I know Miami. And I think I know that homes appreciate a lot in Miami or Orlando, right? So if you're just looking here and you're putting yourself in the shoes of somebody who might not really know how return on investment actually plays out in those markets, Could you pick a winner from that and say, where's my dollar going to be best served over the next 20 years? And why?
Not immediately. If I was to take a guess, Tampa looks pretty good with like the good rent appreciation and the home price appreciation.
You'd at least put Miami up there because you'd see 5.8%
yeah,
home price appreciation. Most people don't even think about rent price appreciation.
Yeah, sure.
What gets, if it's ever written about, well, this market has appreciated more than others, and people are conditioned to kind of think about home price appreciation here. So you wouldn't know how the numbers played out, but you certainly wouldn't look at Miami and say, well, that's one of the least profitable ones to be in for the next 20 years compared to these four. That's why you got to put the numbers behind it. And that's why I'm excited we're able to do that.
All right, cool.
So now we're taking it to the 5 profit centers, the same profit centers that we teach on the show often and that, are the foundation of why you should put your dollars into this asset class. And we're breaking it down for Orlando, Tampa, Miami, and Jacksonville. You want to take it away? What do you see?
I see negative net rental income in Orlando and Miami, which immediately turns me off. And then I look down and I see total profits across the board. Orlando, 1.8 million and IRR of 7.6%. Tampa, 2.3 million, IRR of 8.9%. Miami, 1.8 million, IRR of 8.7%. And Jacksonville, 2.1 million, IRR of 8.7%. I'm surprised that Jacksonville has more overall profit than Miami based on the idea that Miami is already like a higher home price appreciation with a bigger ticket item.
Right.
Like that's the first thing that stands out to me. And then after that, I'm like, damn, Tampa actually looks pretty good.
Yeah, I think that's really good. Let's talk about the Miami thing first and foremost. It does have more home price appreciation. It has $2.5 million that you're going to earn in home price appreciation over 20 years with an investment of that size. So substantial. But what a lot of people don't think about is what does it take to get there and how much risk am I taking along the way? So you're going to have to dump 95 grand in net rental income along the way. There's that risk component, right? It doesn't meet the threshold for, best risk adjusted returns because you got to go out of pocket to the tune of almost $100,000 to get there. But most investors don't take that extra step, right? They don't take that extra step and meet that standard, which is cash flow positive first. That's the entrance to the dance. And then we focus on the other profit centers.
We haven't said that in a while.
I know, man. Bring that back.
Positive. I like it. I like it. I like it. Okay. Yeah. That's interesting, man.
And then look at Tampa. So again, this is all objective, right? This data, it is what it is. And truthfully, I hadn't looked at the Tampa market in quite a while.
Yeah.
The information has come in as far as updated rent price appreciation all the way through current and then home price appreciation. And Tampa market looks pretty good. I was surprised that the numbers stacked up so well. I was surprised that it was close to the amount of net rental income that you could get in Jacksonville.
Yeah.
And the biggest reason is because their rent price appreciation and their home price appreciation has gone up, especially over the last 5 to 10 years.
What's happened over the last 5 to 10 years?
Glad you asked about that. One thing that has happened in Tampa and Miami is that their downtowns have revitalized and have become a growth engine, not just for that community, but a growth engine for rent price appreciation and home price appreciation in the Tampa and Miami markets. If I had done this data, call it 5 years ago, it would tell a different story because the rent price appreciation and home price appreciation in Tampa and Miami has gone up a lot.
Totally.
And a growth agent is because of what specifically has happened in downtown Tampa. We'll focus on that one. So it's called the Water Street Development District. If you've been to downtown Tampa, it is a completely different place than it used to be 15 years ago.
Totally.
They've been able to place make. They've been able to incorporate the river downtown, make it a walkable, activated riverfront. They've been able to bring their sports venues online, and they had investors coming in to the tune of $4 billion that they put into downtown Tampa. And now we're 5 years into that development, and you're starting to see the value of the single family residential properties, workforce housing properties around downtown have gone up substantially. Do you see any parallels about things that we discuss on the show here, Pablo, in relation to Jacksonville?
I see some parallels. I see something that we talk about all the time, which is one of the big reasons why we want you to come to the summit. And it's this idea that if you know that a downtown is going to pop, it is like knowing to buy Apple stock before they announce the iPhone.
There you go.
Like I think that that's one of the most interesting storylines that we've had here over the last 3 years. And right now is this moment where you can really, really feel it and it's becoming very, very real.
Yeah.
If you come to the summit, right, which you can go to at jwbrealestatecapital.com/summit and register and come. But yeah, man. So I went back to the slide before this because you see that the home price appreciation in Tampa is 5.4%, Miami is 5.8%, Jacksonville is 5%, right? So like if I was to then take what we're saying is over the next 20 years, if what we know is going to happen in downtown happens, then we also expect this HPA to go up as well.
That is the opportunity. That's why you got to come to the tour to see it as well. Excuse me, to the summit to see it as well. But that is the under promise and over deliver opportunity here. We know that before Jacksonville's downtown revitalizes and grows, we're already really close to the same home price appreciation levels that we've seen in other parts of the state and better than other parts of the country. And that's before the big catalyst that happened in Tampa and Miami. But if you can get in and you can start to build your portfolio at a time like right now, before interest rates go down, you're betting on that curve going up. Instead of it being 5% for the next 20 years, maybe that's 5.2%, maybe that's 5.4%. That can happen when you have such a growth agent like a downtown coming online. So I think it's really cool to see another market that is another good investment opportunity here, objectively speaking, just based on the numbers, and also look at why, and what does that relate to Jacksonville? Because Jacksonville it hasn't happened yet.
So GC, does this make you want to expand JWB to Tampa? Like I'm seeing Tampa as a good deal, right? Like looks great, right?
It certainly is worthy of the conversation for sure. But what's the number one priority when making a decision to invest in rental properties, Pablo?
The team.
The team, right? What we're looking at here is the number 2 criteria for making a great rental property investment, right? The number 1 is the team. And so before you look at all this data, you should be doing your due diligence on a vertically integrated provider where you have a team that you feel is worthy of handling your dollars and turning those fancy spreadsheets into actual returns on investment and making this a wonderful client experience. Find them first and then go and look at the markets that they serve. So JWB has planted our flag here in Jacksonville. We're not going anywhere. We think this is the best market to be in today, and we think it's the best market to be in for the future, especially because of some of the big opportunities that we have in our marketplace. If you had a JWB type of vertically integrated outfit in Tampa, that would be a wonderful thing to consider. But don't get it twisted. Don't go to Tampa just because the numbers look good here and then find anybody to work with. Find the best of the best. And if you happen to find that in Tampa, then start to look at the assets, start to look at the overall city and make your decision that way.
And you guys won't expand to Tampa because you think growing a team that's vertically integrated is too difficult to do in 2 different places, essentially?
I think it comes down to the best way to serve our clients, the best way to serve our team, really. I think people discount how difficult it is to build a vertically integrated operation. Guys, it's taken us 18 years to get to the point that we're at, right? And it wasn't always smooth sailing, right? We started in 2006 and we were there in the Great Recession and we survived and have learned how to thrive since then. But there is just magic inside these walls and it's the people that we have, and so I relate that to risk for an investor. A lot of times, especially before we started to do the show, people would say, oh man, I wish JWB would go to this market, go to this market, go to this market. And now what we start to see on the show is, I'm so glad that you guys are in Jacksonville because I know that this experience is going to be delivered upon. The promises are going to be delivered on. So I believe that in terms of best risk-adjusted return on investment, staying in one market, planting your flag, and making a real impact there is best for the clients. And then, in addition to that, there's the community. Think about the impact we can make here in Jacksonville. The homes that we build for new construction and then give to members in our community, right? We have 5 families in Jacksonville that have a brand new home that was donated to them because of all of you and JWB Cares and our entire network coming together. If we were in 5 different cities, that would be one family, right? We have a fraternity of people here.
You got a starting basketball team.
Yeah, we do, right? And think about what that does for our community here in Jacksonville. And there's a million other examples. So there's the investor perspective, there's the community perspective, and then there's the team and the personal preference. You know, my business partners and I live here in Jacksonville. We absolutely love it here. Our families are here. We have young families, and we want to be here building the special thing that we have. So there's really not a desire to go and chase a few dollars to go to another marketplace.
Got it. Okay. So if we're looking at all this stuff, right? You're looking at net rental incomes, tax savings, principal pay downs, home price appreciation across time. You're looking at one of the other indicators here, the single family workforce median sales price and median gross rents and your total investments. And as you're looking at it across the country, Jacksonville compares very, very favorably to a bunch of cities that we know to be places that people like to invest, like San Francisco, New York, Atlanta, Cleveland, and Ohio. And if you dial in really into Florida, really only Tampa compares to the return and overall risk mitigation that Jacksonville provides. But before you do all that stuff, you got to find team first. So if you can go do your homework there, find a great team, then Tampa is a viable option. If you can't, then you're really, that you have that team in Jacksonville. So you can look in Jacksonville. We got a couple of Q&As here. You ready to jam?
Let's go, baby.
All right, let's go. The MVP, Lee Bishop, you may have heard of him, says
upcoming guest, upcoming event attendee for the summit.
Lee you're going to be able to hear Lee's laugh for blocks.
Yes,
Just letting you know that. All right. Is the home price appreciation for Jacksonville now 5%, up from the usual 4.7% over 30 years, which is up from the old number of 3.7% used for JWB evaluations in the past?
You can tell Lee's commitment to being a part of this community. He's seen that number go up over the years, and it has gone up over the years. So the number, including last year's home price appreciation, is 5% average annualized home price appreciation in the Jacksonville market. And that goes back since 1982. So that's up significantly. What you'll see for clients who are buying properties today, and for new clients, for existing clients, what you'll see on your property evaluations is JWB likes to underpromise and overdeliver. So on your actual evaluations, we use 4.8% as the expected annualized home price appreciation rate, because we want to beat our returns that we tell you to expect and build in some opportunity to do that. So, but yeah, overall, the data shows 5%.
Okay. Lee has another question. Highest tax savings are in Jacksonville. How is this number justified?
More rental income.
More rental income, more tax savings.
Yeah, it's a write-off, right? So the way that you actually take advantage of these tax savings is you have to have net rental income to offset, So if you don't have any net rental income to offset, or if you're negative, you have a tax write-off that you can't take advantage of. And so it just sits there until potentially you might get enough net rental income, but it's not helping you. So that's the reason why Jacksonville has such strong tax savings. It's because we have more cash flow here.
Got it. Okay. Interesting, man. I never thought about that. Not your average guest. Checking in from the text. I don't know if this is Pedro or somebody else, but they're writing, when have those, especially Tampa, been hit by hurricanes? So they're talking about like the 4 Florida markets.
Yeah.
Asking when have they been hit by hurricanes? Do you think hurricanes affect this type of data, GC?
Well, it certainly affects the data over a 20-year time period.
Mm-hmm.
The way that it would affect it most of all would be the insurance costs. So the state of Florida has higher insurance costs right now than in other parts of the country. Part of that is because of storms, but a bigger part of that is because of litigation. There were a lot of litigation loopholes that unfortunately created very high premiums for us in the state of Florida right now.
Yeah.
So does it affect the numbers? Yes. But is that a major decision that you should have? And when thinking about where to put your money? No. Right? It's something to be aware of, but guess what? In every part of the country, you have some type of natural disaster that can occur. And that's why you have insurance in place.
Yeah.
And so it costs more in Florida to insure a property than it does in other parts of the country, but you have insurance. So you just factor that into as a cost here for those who want to get a little bit more granular here. For every Florida market here, I assume that our property insurance costs are double what the insurance costs would be for those properties in the other parts of the country as well to equate for that.
That makes sense.
So that's all you do. You have great insurance. You have a great insurance team that we would connect you with as a part of being a JWB client here. And you factor that in as a cost of doing business, and you see how it all shakes out for best risk-adjusted return on investment.
Two things I want to say here. I really want to like jam and think about in my head as a Florida resident for the last 20 years, hurricanes that have hit, right? So we're going back to 2003. I think Katrina did some damage in Miami before it hit New Orleans in that time span. I don't remember Tampa going through a big one. It kind of always goes like north or south of Tampa. You know, like Fort Myers got hit real bad. Yeah. Orlando, I don't think I've ever heard of having any major hurricane damage.
Oh yeah, I can think of Orlando. I mean, I grew up in Orlando, and hurricanes, I remember one year, I think we had like 3 or 4 that it wasn't a direct hit, of course.
It was a year that 3 hurricanes hit Florida.
Yeah, and they came through the central part of the state. Yeah. So, you know, it's not like you see on the news, but yeah, Orlando has had some impact of hurricanes. I think Tampa's had, if not a direct hit, it had some pretty significant damage over the last few years with the hurricanes that have happened. But look at this, right? So at the end of the day, it's been 20 years that we've been talking about here. These home price appreciation and rent price appreciation levels are spanning almost 40 years.
Yeah.
And if you ask me, does it affect the overall viability of the asset? You know, people are still moving to the state of Florida. There's still demand for the state of Florida. Everybody knows that there's a potential for a hurricane.
Yeah.
So you're still seeing higher rent price appreciation here and higher home price appreciation here than in many parts of the country. Yeah. And so those are the biggest things to pay attention to when you're actually figuring out the best return for your dollars.
Yeah, that makes sense. And that to me, the other point that I want to hit. So Margaret put that Phoenix is going to run out of water at some point soon. And like, she's trying to advise her son to invest in Jacksonville.
Oh, nice.
And it's like, to your point, I'd rather have insurance for a natural disaster than an impending thing that doesn't have a problem solved that will inevitably be way too expensive kind of thing. Right. So I don't know.
Absolutely.
I guess everywhere has its things. Our thing is generally solved by insurance.
Yeah. And we haven't had a direct hit by a major hurricane ever.
That's Jacksonville, right?
Yeah, Jacksonville. That's what I'm speaking for. So no direct hit there, knock on wood there. And we haven't had a hit from any hurricane since 1964. So knock on wood again.
There you go, knock on wood. Leo Faraganan asks, how is the outlook/appearance of Jacksonville downtown? Are there some homeless people camping out like in San Francisco?
You know, I think one of the beautiful things about coming to the summit here in February is you're going to see what a downtown looks like before it starts to pop, before it becomes Tampa, before it becomes Nashville. And so, and for those who came to the tour, to the meetup, as it was called the last few years, you've walked through the city and, you know, it's been kind of like 2 ways of looking at the same thing. You're seeing the vision that I've been telling you is coming, but you've also been walking down the streets and you said, hasn't happened yet. We've had some vacant buildings, right? We've had some homeless that have been on the streets. So that's very real for what Jacksonville looks like right now. It's in this tipping point where right now there's a lot more positives than there even were a year ago.
Yeah.
A lot of JWB's properties downtown have been renovated and are full of businesses and are full of folks living there. There's a lot of other projects that have come online. So if you look last year to this year, you're gonna look at it and say, oh my gosh, I see so many positive things happening. But if this is your first time coming to Jacksonville, I want to just be real with you. You'll go through downtown and you'll say, I still see a lot of vacant buildings. I still see homeless there. And so that's really kind of where we're at right now. We're at this tipping point. It's before it starts to pop. And from an investor perspective, and just from like a fan of seeing something cool like this happening, like this is the moment to see it. You don't want to just figure it out after it looks like a, 18-hour city or a 24-hour city.
Yeah.
You want to see it in that transition step because that's where your dollars can earn the most. And I just think it's pretty cool to be on the inside. So
yeah. Like I said, like to me, it's equivalent to like a stock insider tip, which is illegal in the stock market, but in real estate, it's not.
Yep.
Right. I would say, Leo, having someone that's been to San Francisco multiple times over the last 20 years, I haven't been to San Francisco since COVID, which I feel like everything's gotten much worse, at least from what I read. But I'm hesitant to like really, like make an assumption based on that because we know that we read stuff about Florida and whatnot. But the feeling of homeless folks that I've seen over the 2000s in like San Francisco and LA, right? Like Skid Row in LA, or like the San Francisco homeless population feels very, very different. Like you see like a homeless people here and there in downtown Jacksonville. I've never been like afraid for my life, which I was the first homeless person I saw in San Francisco kind of thing. Just a different kind of feeling on it. We are much less dense. The overall number of it isn't as much. I can also tell you that in Florida in general, we have really good examples of how to deal with it. Like Miami overcame a homeless population issue in a short amount of time with some innovative ways of doing it. And I think that that's going to be like copied throughout the state. So like Gregg said, you'll see a homeless person here and there in downtown Jacksonville. I've never felt unsafe in downtown Jacksonville.
Right. There's certainly not camps like you see in some of the other major cities, especially, I remember going to Portland and seeing a lot of camps. So it's certainly not like that. Yeah. Right. Yeah. I think, and our theory here, and I really want to get some data to back it up, but our theory on the homeless situation here in downtown Jacksonville, if you start to compare the number of homeless that we have in downtown Jacksonville to some of the other major cities, the thought here is that we have a lot less. The problem is we have a lot less people living downtown. And as of right now, the city tends to shut down after people leave work. Correct. Yeah. Right. So it is something that from an economic development perspective, we really need to get more people living downtown. Yeah. And at the same time, we want to be able to help and come up with a great solution to help our folks who are homeless as well. And so I think we can do both of those.
Yeah. Jeopardy Queen, Margaret Smith, another great question. People come to Sarasota mainly as retirees. They spend their IRAs to buy and live here. So we don't need industry. How do Jacksonville residents make money? What are the top 3 business types out here? I love this question.
Oh, I love it. So logistics is number 1. We have the 2nd largest port in the state. And if my memory serves me correct, don't quote me on it, but I think the economic impact to our port is, I think, $31 billion to the region. So it's a huge driver of jobs. Then financial organizations, fintech. We have
a couple of Fortune 500 finance companies.
Thank you so
FIS.
much. FIS. Oh my goodness, it left my brain. Right. FIS, which is a Fortune 500 company. They've been here for a very long time. They just built a $186 million corporate headquarter in downtown Jacksonville, renewing their commitment to Jacksonville. And we have a lot of financial organizations. Deutsche Bank made a home here. Paycor just came here. Dun & Bradstreet just came here.
Fidelity has their headquarters
here. So a lot of, especially in the Northeast, a lot of the major financial firms are seeing the cost of living down in Jacksonville and seeing the type of talent that we have here and the type of quality of life that we have here. And their people want to be living here. And because more jobs can be done remotely, they're setting up shop down here. So I would go with financial and fintech would be number 2, and then healthcare. I mean, we have the Mayo Clinic here. We have an incredible hospital system here. People come from all over the world to get healthcare services here in Jacksonville. And so we have a hospital on almost every single, major block here in Jacksonville. So those would be the top 3.
Yeah, those are the top 3. And I would also add to that, we have a major military presence. So the government is also a big employer. And to me, I say that because if you think about logistics, you think about healthcare, finance, fintech, healthcare tech, and then you think about the military and government, it's a very well-balanced economy. When I was in Miami working on economic development in Miami, we knew that we were way too reliant on tourism and on hospitality and on construction, quite frankly, to drive that economy. And we were going really hard to build the life sciences, healthcare part of the economy and the finance and fintech side of the economy. And that's something that Jacksonville has always had and creates this very, very balanced economy of great jobs.
So, well done.
Yeah. Last question here, Vonda Lynn. So is there negative cash flow for the first 3 years with 35% down?
It depends on a few things, but yeah, you can have negative cash flow at 35% down. It really depends on the interest rate that you have. A few ticks of your interest rate can really kind of swing it from cash flow negative to cash flow positive. So overall, especially for JWB, we're going to sit down with you and understand what your goals are. And for many of our clients, cash flow positive is the number 1 goal, especially starting out. That's where we're going to put you. So we're going to create the portfolio for you that makes sure that you're cash flow positive, break even, knowing what interest rate, knowing what percentage down you need to be. So it's kind of financially engineered for you and also based on interest rates at that time. So that's the way we would do it. And then in other markets that we reviewed here, you certainly are seeing that those can be very cash flow negative with 35% down.
All right, sweet. GC, good show today, man.
Yeah, man, this is great, man.
Good
Thank
job
you.
on that research, man. Like I like when GC showed me this data, I was like, man, I've been asking for this for so long. So I forgive you for bailing on me to run this
Sorry,
morning,
buddy. I'm sorry.
to work till 2:30 in the morning to like put this thing together. I know you care. I acknowledge it. I don't want to make you feel bad that I'm just sitting here gaining weight because we haven't gotten running.
It's all good, man. I think this data here, the reason that I put so much time and energy into it and was putting, the bells and whistle on it last night is because I think this is something that we're going to have as a foundational piece for us. I hope that this was something that's easy to digest, to see why I love Jacksonville, why our clients love Jacksonville. And, I think more education and transparency and just ease of understanding there can really help people make some really smart decisions.
You know what else I think is going to help people make decisions? Come to the summit.
Hey, heck yeah.
Once you see it, you're going to believe it. I promise you that. We have had really, really amazing experiences at these first two. I am sure that this one, year 3, is the one that everybody's going to be talking about for years to come. So I really, really want to meet you all. I know that I think we had like 10 people already buy tickets. 12. Thank you.
12.
Cody.
Love it.
Cody's on top of it. We already got 12. We're sure this thing's going to sell out. It's going to be an intimate experience. And it's going to be a lot of fun and a major growth for everybody. So.
And we're coming to you guys first. Like we are fresh out of the meeting of finalizing this.
Yeah.
Literally, we're bringing this and we're not going to go heavy into marketing it just yet because I want you to be there. You guys show up every single show, Tuesday, Thursday. You take hours out of your week every single week. This is meant for you to be there. So we're coming to you first. It is going to sell out. We're really, really sure. We had more people show up last year than we expected.
Mm-hmm.
And I want you to be there. I wanted to get to meet you. So go ahead, sign up, go to jwbrealestatecapital.com/summit and get your tickets and get ready to party. It's going to be fun.
All right. And with that being said, next week, we're going to have our favorite fiduciary financial advisor friend, Kelly Barenbaum. There is a rule out there called the 4% rule of retirement that I think we have all heard about. And it essentially says you need to save up enough money so that 4% of that is what you live off of every single year. We're going to revisit that rule, given the fact that so many people are having issues retiring in the US and getting to that number and whatnot. And I think there's some really, really interesting parts of how real estate kind of flips that rule on its head that you're really going to hear. And you're going to love meeting Kelly, who we met personally at the last
Absolutely.
meetup. I assume she's coming. I don't know. I think she said she's coming last week. I'm not going to speak for her, but I'd be shocked if she doesn't come. But yeah, I guess we get to ask her on Tuesday.
Well, I guess we do. It's very rare to be able to speak with somebody who is a super talented financial advisor who also puts their money into rental property investing.
Yeah.
It's really rare. So it's a great treat to be able to spend some time with Kelly. She also has gone through the process that many of you may be going through right now, which is starting to learn a little bit about this asset class, starting to learn a little bit about JWB, starting to learn about Jacksonville. And she came to the meetup last year, and that's why she decided to invest with us. And so we're super excited that you all get to spend some time with her. I can't wait to see her again. It's going to be great.
Okay. Love it. GC, from now till then, any advice?
Don't be average.
See you next week.